I think the ECB is going to leave policy rates unchanged, just like you said. In the last year or so, they printed about 800 billion euros worth of money to buy bonds and buy assets. Generally, when the ECB does what they say they're going to do, it's good for equities, it's bad for the currency. But here, I think the market's expecting them to do more than what they've done already. I.e., either they've got to increase the amount of assets they're going to buy, they're talking about buying corporate bonds, or they've got to increase the size. If they do neither, I think the market's going to be disappointed, and I think we're addicted to liquidity now. So we need more and more from central bankers for equity markets to go up.
Speaking of which, Kumar, payrolls Friday. Let's turn the conversation stateside. Is a Goldilocks number the best case scenario still for risk assets, and what would that look like?
Sri, I think the payroll number is just one of three things that the U.S. we have to be concerned about, and payroll is part of the data, right? So last month was slightly disappointing with 160,000. I think consensus about 160,000. So just if you look at economic data in the U.S., you could argue that the Fed has to start moving rates again. But if you get away from economic data and look at the fiscal side, look at elections in the U.S., look at Brexit, and look at the FOMC uncertainty, I think the Fed can wait for June and not raise rates. I think they'll go in July, but also depends on payroll. But on average, in the last 4 or 5 years, payrolls have been about 200,000 a month. So at about 160, 170, okay. I don't think it's a smoking gun for the Fed to go.
Right. So let me just get you to elaborate on that. So the risk is tilted towards a cautious Fed as opposed to a high US rates environment, yes?
The market's telling you that already, right? If you think of the last 12 months, what have you got? You got the Fed raised rates in December by 25 basis points. The equity markets over the last 12 months are actually flat to negative across the world. If you look at bond yields, they've actually fallen. 10-year treasuries have fallen like 30 or 40 basis points. So the market's basically saying that fiscal side and fiscal policy and elections, a lot of uncertainty, Brexit's an uncertainty, monetary policy, actually printing money really is not doing anything anymore. So they need something different than just rhetoric and talk from both sides.
Let's wrap it up, Kumar, and let me ask you this. How do you allocate in the short term? And producers, bring up that chart again of all the risk events over the course of June, because it is going to be turbulent. Should you be de-risking portfolios, Kumar?
Look, I think you should, because a lot of the returns are going to depend on single event risk and decisions that are going to come out, whether it's the FOMC decision in the middle of June, or if it's the Brexit, which we don't know what the outcome is. So the harder part is trying to figure out, you know, on those single event days, if it goes one way or another, what is that going to do to your asset and asset returns? And I'd rather be a little bit more cautious than own risk assets here at the levels where they are, which is equities. I wouldn't own equities at these levels.